In this video, we're going to talk about Aterian, trading under the ticker symbol ATER. Aterian is a consumer products company. It has its brands of home and kitchen appliances, beauty products, and consumer electronics. Recently, the company has been the center of a lot of attention and speculations between those who want to short sell the company and those who want to short squeeze the short sellers. The reason behind the current dynamic is because on one hand, short sellers want to push the stock price lower because the company is incurring operating losses. They can do this by borrowing shares and can sell the shares at market rate, then recover them later on in order to make the difference as profit. The trading volume of Aterian has recently been 3.2 million shares, compared to an average of 3.7 million shares on a daily basis. Over the previous 52-week period, its price has been fluctuating between $3.04 and $48.99. The market cap of Aterian is currently at $220 million compared to an enterprise value of $377.8 million. The difference between the market cap and its enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of the impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principal, which in turn may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and this is especially true for growth-type companies. For many of those, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than other companies of the same sort, partially because it may have a good management, strong brand recognition, bigger following online, and so on. In other words, it's not a tangible asset which the companies can use. However, it's often the reason why some companies are perceived to be trading at a discount when we compare the market cap and the enterprise value. This is because the market cap is lower than the enterprise value, even if a lot of the enterprise value is in turn calculated based on the goodwill. So, in comparison to its historical price fluctuations, the stock has been 10.5% higher than its 1-month low. Same goes for the 3-month low, and 35.2% higher than the yearly low. In terms of the options market, which often gives a hint on a market sentiment on where the stock price is likely going to head toward, the implied volatility is 1.202 compared to a historical volatility of 1.16. The put-call volume ratio is currently at 0.35, which means that in terms of the put and the call options volume, the call contracts are 3 times more numerous than the put contracts. The most recent volume of options traded has been 1857 contracts within a day, compared to the 30-day average of 5805. In terms of the open interest, the most recent volume of open interest has been 61,000 contracts, compared to a 30-day average of 75,000 contracts. In terms of its shareholder structure, institutional shareholders own 18.9% of its outstanding shares. The biggest shareholders include BlackRock, Vanguard, and Citadel. The relevance of shareholder structure is important to determine whether you should be holding the stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify the long-term trust of shareholders. Now, obviously, there are a lot of exceptions from what I just said, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. Let's also look at the short-term presence in the stock, which is the amount of positions that aim to profit if the share price goes lower. Sometimes, if there are a significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what's going on with GameStop and AMC. With Aterian, this is exactly the case. The current short interest is 25.8% of the total float, and 43.6% of the dark pool transactions are also short positions. Now, let's take a look at the indicators as well. Financial indicators give us a hint of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. The oscillators are showing 1 sell, 8 neutral, and 2. And overall, they're suggesting the tendency to be neutral. The moving averages of the past prices actions have 13 sell, 1 neutral, and 1 buy. The overall tendency from the perspective of moving average is strong sell. The moving average can be used to determine if the stock is overbought or oversold compared to its previous price fluctuations, which can be used to see if the trade is sufficiently well timed. Now, in terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $2.29, $3.68, and $4.55. For the resistance levels, they are $7.24, $8.21, and $9.61. Looking at the stock price of Aterian over the past few sessions and weeks, it seems that the share price has been stabilizing after the significant volatilities downward. The market participants are willing to believe in the eventual tide reversal at the end of the short squeeze, and this is why we should never rule out this scenario despite the fact that right now, things are not going in favor of those who are long the stock. My opinion on the company remains overall bullish. Fundamentally, it is a very hard sell to go against a potentially massive volume from retail traders. With that being said, it is fair to say that the market is not providing enough trade volume for the moment for Aterian to go up. But it doesn't mean that things will stay like this forever. Keep in mind that the bottom of the stock, as far as we know, has been $3.12, and that it's approaching this region and not going below it yet. My recommendation is to make sure that your exposure on Aterian remains below 1% of your portfolio, but to keep an eye out for any potential support in sight. It's a bit far away from our goal right now to talk about any profit target, but if you really want one, I would say that a target of between 30 to 50% is realistic, assuming the short squeeze goes through. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.